Hi, and welcome back to Market Mechanics in the Order Flow Mastery course from Deep Charts. In this video, we're going to go through order matching with a little more detail and get deep into the rabbit hole of how order matching works. So this is a scheme I've prepared for you guys that basically shows you that, for example, a trader, a market taker, might buy market, and as soon as he sends and clicks the buy market button, that order from his broker through a data feed will go to the exchange. Every order will be assigned, if it's an aggressive order, an aggressor order ID. So that order has a name. That order is tracked by the exchange. We know that order has a name, okay? It's sent through the broker, through the data feed to an exchange that through a matching algorithm will match it with our dear order book, which is made by limit orders, right? Traders who placed limit orders here. So we can see the path of that trader. That trader, as a market maker, put a limit order, a passive order that has its own ID, its own identification, its own name, through the broker, through the data feed, to the exchange, placed in the book. And the matching algo will take this buy market order with this aggressor ID, take this sell limit with the passive order ID, and match them. And there's going to be a lot of orders here, right? It's not just one trader. There's probably thousands of traders in the order book placing buy limits all over the place. So who gets executed first? That's what the matching algo is all about. So for example, this is a first in, first out, right? I wrote first in, first out. So here you will have a queue of orders. So the first order that was placed here, whatever quantity it is, okay? It can be 1, can be 4, whatever quantity that order is, whatever quantity of contracts, that order will be the first one in the queue of the book. So chronologically speaking, the first one who put their order there will be the first one to get filled. Same thing with, of course, aggressive buyers. This is the FIFO, the first in, first out. And there's many different types of matching algorithms. We're going to go deep into this one and discover another very important one and very common one in the next video. Hi, and welcome back to the Market Mechanics course. This is Market Mechanics 104, types of order flow and data feeds. So whenever you're going to buy a data feed, you're going to get some level of data, right? As we discussed, you need to purchase a data feed that grants you access to the order flow data. The first type is market by price data feed, level 1, top of book. So when you get this and you open your depth of market, right, this guy, you're basically only going to be able to see the first 2 levels. As you can see here, 100 and 99. I have 23 and 29, right? Only the first 2. So you're going to see the total amount per level of price. Market by price. Same with the orders. You're going to see all of the orders coming inside. That's all the data you get. Or you can get a market by price data feed, level 2, that shows you the full market depth. This, for example, is a full depth book. Right? You can see a lot of levels inside of the book. So you see all the levels up, all the levels down. You can see if there's areas of liquidity that are significant. For example, here I can clearly see, if I make this bigger, that I have 160. There's a big seller here, and yeah, there's other big sellers here. So these are areas that are likely going to be visited by buyers. Okay. But still, I just know the total amount. The next level is seeing every single order, okay? Because here it can be, this 5 contracts could be one big 5 contract order or multiple small orders of 1 each. That's market by order data, or level 3 MBO, market by order. So this is a granular version of order flow that not only allows you to see the total amount, but also tells you if there's something interesting, if there is one order which is radically bigger than all the others. What are the big trades? Both from the resting order, because every resting order has its own ID, and every aggressor order as well has its own ID. So both from the aggressors and from the resting orders, thanks to MBO, market by order data, the exchange is granting us access to order IDs. So our Deep Charts platform can take these orders and replicate it and take this data and plot it on a chart in a way that we can filter out the real big traders. And that's the power of using a technology like Deep Charts with an MBO compatible data feed. This is also useful to spot icebergs, because as you will learn later in this course, smart money tries to hide, and it is able to hide from price action traders, but they cannot entirely hide from order flow traders. And that is going to be all clear thanks to MBO data. So to summarize the features of each type of data feed, you have market by price level 1, which is enough for basic footprint charts. Volume profile, you just need level 1. No need for level 2, no need to pay a lot of money. Which by the way is $20 a month, $20 or $30 a month. It's not good for depth of market analysis. So if you want to see liquidity areas and stuff like that, you're not going to be able to see it with level 1. With level 2, yes, you have the full access to the DOM, to the depth of market, the whole order book with all of the buyers and the sellers and all of the liquidity areas. That's level 2. It's essential, especially if you want to use heat maps like Deep DOM. Level 3 data is crucial because it provides order IDs that allows our technology to aggregate fractional trades and native icebergs, which we'll get deep in the next lessons. The most common futures data feed are DXFeed, Rithmic, and CQG. Rithmic being the only one that has fully accessible and fully, let's say, playable with APIs. So with Rithmic, you can see native icebergs specifically. With DXFeed, you can also have level 3 data, but you don't have, there's some problems with the APIs that we're trying to solve. You can see big trades, for example, with DXFeed, but you're not really seeing the icebergs. Okay, that's a slight difference that we're going to get deep into later. Don't worry if you don't understand what I'm saying now. But these are the most common types. These are very high quality data feeds. They're reliable, and They're very, very, very solid. They give you the real exact data with probably the least amount of small mistakes here and there, but almost close to zero mistakes in the order flow. So absolutely phenomenal tools. We're proud to have all of them in our platforms. And these are the most common ones.
This is how stock prices move. For every higher price, there's people who are offering to sell maybe one stock or future and basically say, who wants this one stock? Who wants this one? Who wants these two stocks? For lower prices, there's people offering to buy shares or futures and say, hey, who wants to sell this one to me? Who wants to sell this other one to me? And all these buys and sell offers are summarized in the so-called order book. The best bid and the best offer create a little space between them called spread. But this is just the top of the book, level 1 data. The same thing though happens in every step of the price. With level 2 data or market by price, you can see the full market depth. With level 3 data or market by order, you can also see every single order. But again, these are only passive buyers and passive sellers, also known as market makers. They're just offering to buy or sell. Someone needs to take action. So an aggressive buyer might come in and act as a market taker, which basically says, hey, I will buy 2 of those by clicking the buy market button, which will send his 2 buy contracts to the matching algorithm that through a first in first out system will match it with the first sell order that was offered. The price they were matched becomes the new price and the candle opens. If someone else buys 5 contracts market, the matching algorithm will try to fill them at the most convenient counterparts. So 2 will be matched here, but 3 will be matched slightly upper. This phenomenon is called slippage. Now the last price there was a match is the new price and the candle ticks above. If someone sells 8 contracts market but there's no counterpart, he will also be slipped at the best price where there's at least a buy offer. 3 contracts will be matched here and 5 will be matched here. As soon as they're matched, the new price will be 98 and the candle will move here, turn red and leave a wick above where it used to be. All the contracts that were traded will be shown in the volume profile or in the footprint chart. Soon enough, the book will repopulate with new orders and the auction can continue. You can follow for the next episode and
Hi and welcome back to the Order Flow Mastery course. In this lesson of Market Mechanics 105, we'll get to meet different types of matching algorithms. The first one, as we know, is the first in, first out system. So per every level of price, we're going to have passive buyers and passive sellers, right? And these are every single orders. Let's say this is market by order, right? And let's say any buyer or any seller comes, the first order to be placed in the queue chronologically will be the first one to get filled. So if this guy came here first, he's going to get filled first. Then the next one, then the next one, then the next one, then the next one. Same here. First this one, then this one, then this one, and so on and so forth. This is very easy, first in, first out, very common. But something even more common is the first in, first out with lead market maker. So in the book, in the market maker side of the book, you will have a market making firm or multiple market making firms providing liquidity. Why do they do that? Well, that's a very profitable business model that I can explain you pretty quickly. But fundamentally what they do is they provide both bid and ask at the same time. So their business model is to always sell slightly up and always buy slightly down. So if they sell 10 contracts at 100 and then buy them back at 99, they're always earning this $1 point, right? Which, as we discussed, is the spread. So if spread is what market takers pay to trade because they're in a FOMO and they can't wait to get their hands on a buyer or on a seller, the spread that they pay is a hidden fee that market makers earn instead. That's why you see often price going up, down, up, down, up, down, up, down, uptick, downtick, uptick, downtick, uptick, downtick. Every uptick and every downtick is huge amounts of money for market makers. So they're not just putting a sell limit here because they hope price will go down. Yes, they hope price will go down of a single tick. But they're constantly buying, selling, buying, selling, buying, selling, buying, selling. And this is a very profitable business model for them, but it's also really good for the exchange because the exchange can guarantee a constant level of liquidity with really tight spreads. I mean, this is a 1 point spread. I'm okay to pay that, you know? If there was no market makers here, you might have a lot of voids in the liquidity at some point. And you're going to have to pay crazy spreads. And traders are not incentivized to trade there and to pay commissions to the exchange. Because every time you trade, you pay a commission to the exchange. Who do you think you pay to? Just your broker? No, sir. So it's in the best interest of the exchange to have market makers because they can be able to provide tighter spreads. So they will have a privilege. And with a first in, first out with lead market maker type of matching algorithm for order routing in exchanges, you get all of the volume that comes inside of as aggressive orders split pro rata between a market maker and then with a normal FIFO to all of the rest of the market participants. So 40% of the volume will go to them. The 60% will go to these guys. 40% will go to the market maker who's leading. So the market making firms, 60% will go to the FIFO queue. Okay? So they get guaranteed 40% of all the aggressor liquidity that comes inside of the market. So it's a good business model for them. Traders get guaranteed low spreads, and the exchange earns more money. It's a win-win for everyone. But this does not apply under big impact data release news. So the only exception for market makers to not provide liquidity is during big impact data release, e.g. NFP, CPI, FOMC. Because if you think about it, if, for example, a really good news come up and markets wants to pump up, there's not going to be uptick, downtick, uptick, downtick. There's going to be uptick, 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 uptick. And as market makers will be always here selling, but they will not be able to close off their position and buy and be neutral to market direction. And price will not go one tick up, one tick down, tick tock, tick tock, tick tock, and make them earn a lot of money. They're gonna lose. Okay? So that's why they have the ability, whenever they want, to delete all of the liquidity they placed in the book for just a couple of milliseconds right after a big news, a very big impact news has been released. They can do it. They have this permission from the exchange, and they still get the lead market maker status. And this also tells you something interesting, that market makers love ranging markets. Upticks, downticks, upticks, downticks, because that's where they make money. What they don't like is price simply moving up. Market makers don't really like this because they can't earn a lot of money. Actually, they're losing. And that's why they always look for liquidity, and the whole auction market theory model comes into place, but we'll get deep into that in the next few lessons.
When a news is released, such as NFP, CPI or FOMC, here's what's happening behind the scenes. In every market there's two types of traders. Market makers in the order book buy and sell orders resting above and below price, and market takers, people actually buying and selling to the best price. When a market maker and a market taker agree on a price and trade, that price becomes the current market price. So a market making firm will provide liquidity by placing both buy and sell limits. So its business model is to sell at a slightly higher price and buy at a slightly lower price from and to all traders who buy and sell market to earn a spread. This is a massively profitable business. But if the market would start rising all of a sudden, maybe because the Fed has finally cut interest rates,
Good afternoon.
and stock bulls are happy, for a market maker that means trouble, because it would have to keep selling at a higher and higher price and lose a lot of money. So to prevent this risk, market making firms before any news release have the ability to cancel all the orders and stop providing liquidity for some seconds. This way the spread between the best sell offer and the best buy offer will be really wide. All it takes is a buy market order which will be matched with wherever there is at least one sell offer. So price will immediately jump wherever there was a sell limit in a matter of milliseconds. If someone in this time frame sells market, it will be matched with the first buy offer, which could be substantially lower, and in a matter of milliseconds, price will drop. And just like that, with two very small order, there can be a huge volatility simply because of a lack of liquidity from market makers.
Hi, and welcome back to this order flow course, Order Flow Mastery by Deep Charts. This is Order Flow Tools 102, Depth of Market, or DOM. This is the depth of market. This is the DOM. And what the DOM is, as we've understood, and you've probably seen me already using this a couple times, is the summary of the order book, right? And in the price ladder, what are all the orders in the bid and in the ask? And we use this, and a lot of traders simply use this to trade. One of my best trader friends, Serge, is a part of the team together with Tom behind the World Trading Champion Patrick Nail. He's just using this to trade sometimes. He can simply trade just by using it, just by looking at this chart. If you look at Navinder Sarao, he was also trading with this. I personally have never traded with this alone. I would have a really hard time because I need to look at price. I need to look at the auction overall. But there are a lot of scalpers and traders that simply use this, which is unconceivable for me as a former price action trader. But this is normality in the trading pits. We're just trading using the order book. Now we're in a replay mode, so I'm going to press play, and we're going to see the auction develop in real time. And you can see price moving up and down, everything we've seen until now in real time, just from the side of the book. And you can see, for example, that all of the orders that are put here are changing. Look at this 151, 2, 3, 4, 4, 9, because people are deleting these orders. They're restacking them on top. They're putting them, they're taking them off, putting back in, putting back off. And you can see price going up and down, but we don't see the executions actually, right? We just see this and price going up and down. We want to see also the sales, right? So we can activate, for example, a resettable volume profile. And let's reset it for a second. There you go. Well, now we can see not only the movement of price and the movement of the book, but how much money was traded there. It's crucial information to have in your order book, in your DOM, in your depth of market. We can see there's a very big seller here, for example. We have 145 contracts ready to be sold here. And then price just moving up and down, up and down, up and down. And market makers getting eaten alive, okay? And on this side, you can see the volume profile shaping itself and telling us how much money was traded in a specific price level. And from this type of tool, we can spot anomalies in the short-term order flow. And for example, we could have, instead of just this, we could have a delta profile that tells us, for example, who was more aggressive and eventually who was absorbing, which is very useful. We had a lot of buying going on here, a lot of aggressive buying that now has a follow through, and some of the sellers were deleted. Okay, we don't see them anymore. So one could, for example, buy. Now I'm doing it completely randomly, guys, so don't take it as a trade. And for example, if I buy here, I can literally just buy directly from the book, right? And I can put a buy limit here, or for example here, and maybe follow the price. Let's see if this one gets filled as well. Yep, almost there. And as soon as price gets here, we're going to get filled. And I could place, for example, a sell limit here. You see, I can just trade inside of the book and add my orders on top of those ones. This is going to be closing my position, right? Because I'm already bought one contract. I'm long one contract. And this is going to be my take profit. It's going to close my one contract by selling it. Okay? Now we have 3 contracts open. See, they're getting filled. And I can put a stop order here. And I can basically trade directly through the depth of market. I can place my orders inside of the book, just like I'm interacting in real time with the market, with the order book. This is absolutely fascinating stuff. But aside from being just fascinating, you can see the evolution of the auction in real time. See liquidity being pulled and stacked. Seeing with the volume profile where most of the trading happened. Now, for example, we just broke through a very high volume node. It's likely that we're going to move down a little more now. Look at this, 995 contracts offered here. This is an anomaly right there. So, for example, I can flatten, and this one contract is likely going to be executed. Look at this. There was a huge seller and a big buyer that bought it right away. You have 900 contracts being executed here. So, for example, I might join the party and start buying as well and place my stop below here. And if there's a momentum ignition right here and price pumping up, the famous FCHU that Fabio made famous, there you go. I can just take a quick scalp and get out of the market. Okay? This is the type of trading that I am far from being an expert of it, okay? But this is the type of anomalies that you're kind of looking for and kind of taking advantage of in the order book. It's a very frenetic way, it's a very hectic way of trading, of course. But this is one of the way this tool is being used, and that you can simply keep there to see the auction develop in real time, to keep a look on the big orders. You don't need to just look at all the numbers. Just look at what happens when there's a big order. Okay, there's a big order, might be careful, right? And here you can monitor also how fast the book is going. How fast the tape, the so-called speed of tape. And that can tell you a lot about trading activity. Typically when you see fast trading, like now, the tape moving really, really fast, you can kind of assume that the price movement might continue, right? And there you go. This is the order book. There's a lot of stuff that you can do here. There's a lot of stuff that you can set. You can have, for example, a bid-ask footprint. Now, all of that absorption error was completely walked through, so we might expect some selling activity, for example. And you can either have the fundamental here, which is like just some basic, percentage volume, the total volume, blah, 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 some basic order flow data. You can either also hide the trading panel if you don't want it. You can not have anything at all and just have a clean book. And you can completely customize, by the way, in the settings, what types of column do you want, right? So, for example, that's the bid-ask column. You can change the color. For example, I might want to change it at, green. And this one with this green. And now I have it in a different color, okay? And I can add a pull stack column that basically, if I click OK, let's see, tells me the variation of how much was put in the book or taken away from the book, okay? This is the pull and stack. I can have a filled column, so how many orders were actually filled. Let me take off this pull stack. I can have a filled, so it's going to tell me the orders that were actually filled. So it's basically like a footprint chart in real time. So how many orders were filled, so in the bid and in the ask. Okay, and I can see them with numbers without requiring the bid-ask volume profile. So I can just keep a, for example, normal volume profile here, have the, footprint in the middle, and also maybe have a delta footprint. So this can be a very complete way of looking at the markets in real time. And I can add many other columns, for example, offers, order settings, what color do you want them, what color you want the price scales, do you want the P&L, do you want to see the P&L column with the money going up and down, or you can just delete it and not have it at all. And that's pretty much what you need to know about the depth of market and how you can use this. A lot of professionals use this. It's an amazing tool. It's a different type of visualization, I know it, and I strongly advise you to spend some time looking at the book, because it's the rawest form of order flow, and it's one of probably the best ways to get to know order flow, to get to understand the language, to learn how to read the auction. So I strongly advise you to do that, even with a replay, just like we're doing right now. And that's it for the depth of market. I will see you in the next video. Hi, and welcome back to this order flow course. Order flow tools 103. We're going to get to know the deep print, also known as order flow candles, deep candles, footprint, candles on steroids, or however you want to call it. So we're going to take a normal chart, okay? Or we can simply go on deep charts, in the main bar, and click new price chart, right? You're going to select your E-mini S&P, and voila, you have the chart, the same one that I have here now. I'm going to close this. And one of the options you have to do it very quickly and swiftly is to, for example, activate order flow bid ask right from here. And it's going to build a chart for you. And if you zoom in, you're going to be able to see the bid ask footprint. Now let's go down, drop into some minor time frames. And let's go to the 1 minute time frame. This is one of the time frame I prefer to read the footprint chart. And this is one type of visualization, okay? It could be improved, I would say, right? So let's make it better. We can go, this is just the basic version, right? But you can go inside here and all of the settings pops up. So this is an ask bid footprint chart, right? So it's just showing you orders that hit the bid on this side and lifted the ask on this other side. So aggressive selling and aggressive buying. You can also have it a volume, right? Just the total volume here. Or you can have just the delta, okay? So the difference between total volume, ask bid, and delta is the total volume is simply doing this number plus this number. Delta is doing this number minus this number. That's it. Super easy. So 81 plus 110, let's put volume. Let's first make the text slightly bigger, because now with the font size, it's practically invisible for you guys probably. So let me put that really big. There you go. Is 191, the total volume. 81 plus 110. 110 minus 81. So I put delta. It's 29, right? And you can have it as a box. Now it's written box because we don't see the background of it. But you can go on plot settings, background, and for example, color mode, fixed. And now you can see a little bit of the background. Or fading color, which is what typically I use, or multiple colors. And the color calculation, how do you want it to be colored? Based on volume, or based on delta, or dominant volume, or volume dominant delta. To be honest, I always keep it at delta to keep it simple. And the background is this one. So for example, I might want to put it a little bit more lighter. Yeah. And for example, I want to put my text with a main color being Are we on the text settings? Yeah, text settings, coloration. I'm gonna put it black. Yes, I prefer it, for example, like this. But to be honest, I have my template for this. My 1-minute entry template. That is gonna load now, but it's gonna load a little bit more because I typically have 60 days of chart to load. So let's give it a little bit of time to load. And there you have it. I'm going to take off all the rest of the stuff that we're going to see later in the course. And there you go. Look how beautiful and clean this is. My God. I make it even cleaner by putting the chart area black, just how I like it. And there you go. Nice. So let's have this one here. And in the properties, let's make indicators, order flow analyzer, or dip print. Let's make in the plot setting the text slightly bigger. And let's get to know our footprint chart. So a quick reminder of how this works. Let's have this on the side and this here. And with our replay, we're going to play. And we're going to see this thing developed side by side with our depth of market in real time. There you go. Now you can see both of them moving at the same time. And this is basically summarizing the end result of what happens here. So we have passive buyers, passive sellers, the volume profile, and this simply tells us, okay, this is the summary of all aggressive buying, the summary of all aggressive selling. So you can also guess here what happened in the book. Because if you see, for example, just like we saw slightly before, this happening in the book, we saw a big $900 order, sorry, a big 900 contracts order. Well, that's where it is. We don't see it. We don't see it before, right? Here we can see it before it gets filled. Here we see it only once it gets filled, which is ultimately what matters, right? Some might argue what actually matters is executed orders, not fake orders that have been spoofed here. So maybe they put it, they take it off, they put it again, they take it off. It's unreliable information. So I'm just going to stick with what matters and just have the orders that were actually executed. That's the stance I can understand. Okay? So this is what the footprint chart does, or the dip print does. It shows us the summary of the auction that created the candle. This is the best way to analyze market movements. And it gives us some very important data. So let's kind of diversify all of these colors, what they mean, etc. The background color is green, here it's purple, and the darker it gets, the higher the delta. So you're going to compare the number of this with the number of this, and if this one is increasingly more than this one is going to get greener. Same thing here, 68, 2007, well, this one is going to get colored purple, okay? So the delta, as we discussed, is this minus this, or this minus this. So the color is based on delta. The color of the text instead is based on something called auction imbalance. And by auction imbalance, what we mean is the imbalance between what was traded and bought from the ask. So what was bought from the ask and what was sold in the bid in that auction, because you always have the best bid and the best ask at one tick difference, right? Here, let me pause this for a second. So you always have best bid at 50, sorry, best ask at 50, best bid at 25. So this is the best ask. Sorry, now this is the best bid, this is the best ask, right? So this is how the auction unfolds, diagonally. So this is one auction, right? Best bid, best ask, best bid, best ask, best bid, best ask. So there's always this diagonal representation of it, right? That's why we have 0 here and 0 here, for example, right? So it's going like this, it's going like this. And then typically you have 0 here and 0 here. That's what also we call, when you have a 0 and a 0, we call this a finished auction. And we call this a finished auction. When we see a number here instead of the 0, or a number here instead of the 0, like here as well, we call it an unfinished auction. Okay, and we typically expect those levels to be taken out. But you know, whether they taken out or the statistical advantage of it, I'm not gonna give you any guarantee on that. But this is something that, you know, a lot of order flow traders are actually looking at. So these numbers are colored based on the imbalance between what was traded in the best bid and in the ask in that auction. So diagonally speaking. So you compare 78 with 3, well, that's a big imbalance. And we measure the imbalance typically in percentage. So you'll see a slightly light blue color when there's at least a 200% imbalance, and a very highlighted light blue color when there is at least a 400% imbalance. So this number being at least 4 times bigger than this number. Same here, in purple, light purple, you're gonna see if there's an imbalance of at least 200% between these two numbers. And in case the imbalance is more than 4 times, so more than 400%, you're going to see it very punchy and with a big highlight when it's 400%. And in some situations, you know, you're going to see both. You're going to see both a high color indicating the imbalance, a high color in the background indicating delta, and that's where you know there's something real going on, right? This is a clear example of absorption. And this instead, this yellow box that I can see here, is the point of control. So the point of the candle, POC, which is the point in the candle where the highest amount of volume was executed. Okay? And these are all really crucial data points, in my opinion, to formulate a hypothesis of what's going on in the market, on who's dominating in the markets. Because, for example, here, you know, there was a lot of aggressive buying happening, and there was a big seller in the book. Well, we tried that, didn't work, and then we poked out of it, and as soon as it got broken, then we have a long auction that lasts for quite some time. Right? So what the footprint is doing is showing us a picture, a very clear picture of the auction. And in the tutorial section of your user area inside of Deep Charts, you're going to be able to find everything that relates to every single thing about the footprint chart, but I'm going to go quickly through it. You can also able to have, for example, as I said, a volume, but not box, because this is the box version, but a profile version, for example. It's going to show you a profile instead of a single box of that level, right? This is one other type of visualization of this. If you want to set, for example, a different type of imbalance, you can go to plot settings, and in the text coloration settings, you're going to open them, And the color mode here is multiple color based on imbalance. I can go to range and set user defined range, and you're going to be able to see here that the first range is all black, so the basic color is black. Second range is not enabled. You have third range, fourth range. You can set even different ranges. Okay, I have the 200 and the 400% that I told you. So with the 200 is light blue, light purple, light pink. 400% is punchy blue, punchy pink. You could even get crazier with this. Okay, you can have a fifth range when there's a 600 or 1,000% imbalance, right? And put it in, I don't know, a very different color, red, for example. And you're gonna apply and save. Put it back to ask bid. And now you're gonna see also those red when there's a huge imbalance, right? And this is the footprint chart, okay? This is the basics of the footprint chart. And I personally like this, for example, to put multiple footprint charts on top. For example, my 5-minute time frame template for the footprint. I'm going to show it to you now. Just give 1 second to load. So it's going to load the chart now and rebuild the chart based on a different version of the footprint chart. And there you have it. This is another type of visualization of the same chart, but on a 5-minute time frame, and with both the bid and the ask. Where you have both the bid and the ask and a volume profile. So I have the volume profile that tells me where the most money was traded in general, the footprint chart with the bid ask version that tells me who was more aggressive, and the volume profile chart itself is colored through delta. So I have all of the informations I need all in a single chart where I can basically put one chart on top of the other one, okay? And the cool thing about this is, for example, I might go and have in the indicators tab both order flow analyzers, and I might not want them one on top of each other. I might, for example, go to advanced and have it half of the size with a half of an offset, and have this on the side, and then go to the settings of the other one, go to advanced again, have it half of the size again, but without any offset. And I can simply split my profile, my footprint, into two and have them split instead. And this is how customizable it is. And with all these customization, you can literally get every type of visualization that you want. And I strongly advise you through time to find your way to personalize your charts, to play with the settings a little bit, see the type of order flow imbalances that are important for you, the type of colors that you need, the type of information that you think you need and you want to get out of this deep print indicator, because it's super customizable and it can get you to the point where you have all the information you need. And we're going to provide you with all of these templates, of course. But this is everything you need to know about the footprint chart and on how to use it and how we're going to read it and all of the details. We're going to go deep into the next few lessons. For this lesson, that's all, and I'll see you in the next one. Hi and welcome back to Order Flow Tools. This is Order Flow Tools 107 VWAP, or Volume Weighted Average Price. And this is a very interesting indicator. Really, really interesting volume level, which is basically the average price weighted by volume. So it's just like an average, right? Sort of a moving average, you could say, you could argue. But that takes into consideration also the volume. So what was the average price where the average volume was traded? And for example, in a session, after a session, this might be the VWAP, the volume weighted average price. For example, in a session like this, you could see maybe at the end of the session, this would be the VWAP. But it develops throughout the whole session. It starts here, and then it follows price typically, right? So you can see the development of the VWAP throughout the day. And why is this important? Is because it is knowingly, it's very known to be an institutional reference for filling orders. Because this is objectively telling you the volume weighted average price. So if you have a VWAP, if this is the VWAP of a session, anything below the VWAP is objectively discount based on the price and based on the volume. Anything above this will be premium, objectively based on price and volume, based on money. Let's take an example here, and we have plotted here the VWAP, right? And the VWAP, you can simply create an order flow VBP values or deep profile values, go to the VWAP, enable it, and enable the developing VWAP, and this will appear exactly like this. So every session has its own volume weighted average price moving up and down. And you'll see that a lot of the times, this will be the level that they'll keep buying and selling at. And it will serve as an area of support or resistance or a breakout type of thing. Even better than that, as we know that this is a dynamic representation of fair value, so we could call it a dynamic fair value, so the adapted average fair value of the day, we can also use the same statistical concept of standard deviation and plot standard deviation bands all around it. So we go into the settings and activate the envelopes, and in the settings, we set the first envelope with a standard deviation parameter of 1. I have typically 1.5 standard deviation, 2 standard deviations, and 3 standard deviations. So I normally have 1, 2, and 3. You can have 1.5, 2.5, however you like it. We apply it, and we get these bands. And these are, again, just like we did with the volume profile, where we had most of the volume traded here and anomalies happening outside, and that's where we look for trade opportunities, not in the middle, right? Because that's where the average goes. Same thing happens here. The only thing is, this is the first standard deviation. This is the second standard deviation. This is the third standard deviation, right? So remember our bell curve. Our bell curve will be something like this. It's the same thing, but it's not just based on volume, but based on volume and price. This is going to be the average, and these are the standard deviations from the average. And whenever we reach the second or third standard deviation, that's where typically you're going to see a lot of rejection and a lot of de-retracements and mean reversion setups starting to happen. So you can either use these as dynamic target levels or as extremes where it could be worth considering buying and selling to and from. And these are, let's say, the most statistically reliable references, and they are widely used for best execution algorithm in the institutional space. So they will, if they want to sell for that session, they will try their best to fill above here, and if they buy, they'll try their best to fill below here. And that's just what a lot of firms do in case they have big orders to pour into the market and they want to have a better fill. They just take the VWAP as a reference and fill above or below based on their trade direction. So that's why this is such a powerful tool. This is a powerful institutional reference that you can plot on top of your analysis. Don't overuse it, or maybe just focus, but don't try and put too many things on the chart. Just take it as a reference, but as a reference that is backed by money, is backed by institutional order flow, and by statistical analysis. Hi, and welcome back to Order Flow Mastery. This is Order Flow Tools 105, Deep Stats or Order Flow Values. This is an indicator that I think it's very, very useful for scalpers and traders, that can be summarized in different ways, can be visualized in different ways. There's so many data, and it's basically a table that shows you the values of each candles related to order flow. And this is how it looks like. It's the chart down here. And based on how you set it up, it will give you some information, okay? And you just find it in the indicators under deep stats or order flow values. And there's a lot of them, okay? There's literally a lot of them. We're not going to go through all of them now. I'll tell you my favorite ones on this indicator specifically are total volume, delta volume, and delta percentage. So I want you to go to delta volume, select text, delta volume, select text, not ignore. You're probably going to get delta NT. I want you to put ignore, and delta percentage text. That's how you activate it, and that's how you have it. Now, let me show you a little bit how it works and how it's calculated. When you take a footprint chart just like this one, you're going to have, as a reminder, ask traded. So aggressive buy orders that lifted the ask. So traded on the ask, aggressive buyers. And bid traded. So aggressive sellers accepting accepting buy offers and selling to the bid, hitting the bid. So this would be the total bid traded, and this will be the total ask traded. So if you sum it up, 19 total bid traded and 20 total ask traded, you get the total volume. So bid traded plus ask traded is the total volume, which in this case would be 39. If you do bid traded minus ask traded, you get the volume delta. Okay? So you take all the bought minus all the sold aggressively, and you get this. That's volume delta. So delta is answering to the question, who was more aggressive? Who was the predominantly aggressive participant inside of this candle? And by how many contracts? By how much? well, 1 over around 40 contracts. It's not a lot, right? Buyers were like, this was a pretty balanced candle if you look at the effort that was put in. But the result is sell. So you want to use delta always in the context of effort versus result, which is, the basics of volume spread analysis. And, if we go even back to the early stages of Wyckoff theory. So whenever you take a look at order flow stats in this table here, this is what you'd normally see. Total volume on the orange one, which is the total volume traded on each candle. The volume delta, so instead of doing bid, or better, ask traded plus bid traded, you're going to do ask traded minus bid traded, and you get the delta. So the delta tells you the net aggression of a candle. But as we will see, it could also mean absorption. This one here is the delta percentage. So in percentage, compared to the total volume of the candle, how much of that volume was aggressive selling? In this case, 6%. In this case, 20%. In this case, 10% was buying, aggressive buying. So it gives us, with a very simple number, a summary of the order flow of each candle. So it's very, very useful. And this will come in very handy to spot significant candles. For example, inside here, inside this chart area, in this time frame, you had 2.6, 2.6, 2.3, 1.7, 1.7, 3.2, 3.2, 1.6, 5.9. Well, this is a candle that has way more volume than all the rest of them. And we also see that it has a huge delta compared to the other ones. Hence, a huge delta percentage compared to the previous ones. Plus, it's a very big candle. And you will see, if you look at what's happening inside, you will see that there's something going on here, right? There's a big sell, aggressive series of orders that are trying to be blocked by a buyer, and eventually that buyer fails. Sellers, these big sellers, are in control, and the auction moves lower. This is stuff that you simply do not see with price action, okay? So a big trader, there was a war between two big traders here. One was in the bid, one was selling onto it, and one prevailed clearly and sold thousands of contracts and caused a huge swing in price. This is an extremely good sign for a breakout. It's just objective that during this breakout, there was a lot more volume. There was a lot more money involved in this candle that you simply cannot see. Even this candle was big. This candle was big, yes. But this candle had volume. This candle has clear institutional interest that you can see with numbers, not by guessing. This was a wall of orders that got completely ran through, and we moved below. And this is the power of order flow. And we can use this as our map for overall order flow activity. And you will start noticing something. You'll start noticing, for example, that most of the breakouts, not all of them, but most of the breakouts that hold happen to be high volume breakouts. For example, here, what you'll typically see during a breakout is an increase in volume. So we had this as a main range at 4,000, 5,000-ish. And whenever we break out, look at this. 8,000 contracts, 700 delta, which is at least 10%. And then we move high. Whenever there's a lot of volume, a lot of aggression, a lot of delta, typically the breakout will hold because there's an imbalance, there's a clear imbalance. And again here, you can compare. Oh, there was a lot of selling going on here, right? All of aggressive selling, 18% delta, 1.2 thousand. Where are they? Very small candle. Why? Oh, look at that. Something went on here. Something was absorbed here. Interesting. But what happened after? We tried to auction lower, absorbed again. This is a big ass candle, but a flat delta. That's a discrepancy. And what happened here? Oh, there was an aggressive buyer that got absorbed as well. So I can start seeing, first I have my indication below here, and then I can go like a detective into the details and realize a lot of liquidity here, a lot of liquidity here, a lot of money here, a lot of money here. Okay, so this is what we also call a liquidity pocket. So a specific area with a lot of liquidity, a lot of trading going on. And once that's broken through as well, guess what happens? We move higher. How do we break? We break above the range. What happens? High volume. Again, 5, 5, 5, 6, 7. 15% delta, 20% delta, big aggression, boom. And we fly higher, okay? So this is how this tool can be useful. I'll see you in the next one. Hi and welcome back to Order Flow Mastery. This is Order Flow Tools 106, Cumulative Volume Delta, a very powerful indicator that takes something similar to what we've seen in the previous indicator with the order flow values and basically plots it on a chart, which is even easier to understand and gives us a different perspective around delta and around market pressure. So we take the same chart and we add this on top, which is the cumulative volume delta. You can find here in indicators, cumulative volume delta, candlesticks. So let's take this as an example where, and let's start from the beginning of the session because that's where the cumulative volume delta starts happening, let's say. So let me make it wider for you. Yeah. So as you will see, every day the cumulative volume delta will start from level 0, right? Level 0. And by plotting candlestick, it will show you how delta varies throughout a candle. And for example, if we have a delta of 51, the candle will go up around 51. If the delta of the following candle is -9, well, this will go -9. If there's a -126, the candle will be big and go -126, plus 71, plus 71. So the only difference between this one and this one is cumulative. So it takes into consideration the total delta of the entire session and shows you how the delta varies throughout the session. And you can quickly compare it with price action and make some interesting consideration and building a narrative around what price is doing compared to what the pressure of aggressors is doing. Okay? So, for example, in a situation like this one, you could notice, for example, that during this situation where you had one swing low, swing slightly lower, and then high, what did you have from the volume delta? Well, let's see. You had the delta and the pressure going down, and then not plotting another low. So whenever you see that in this leg, price went down, and in this leg, price went down, but the delta didn't, it clearly shows us that there was more effort on this leg that caused price to drop. There was not as much effort on this one. Big effort, big result. Not a lot of effort, but still some result. So this thing tells us that in this leg of price, there was less aggression, less interest, less participation. In fact, that's what a lot of order flow traders calls this, a lack of participation pattern. So whenever you see price doing this, plotting a low, and the volume delta not plotting a low, so there's a divergence of this type, we call this a lack of participation. Because during the second leg of price, the aggressive sellers that cause the movement are not that present. Typically. Now let's make some sort of opposite example where you see that this leg went down in price, you had a leg down in delta, price went back up, and then another leg down. And here you had this and this. So you have an opposite example where during this leg, a lot of effort brought a lower low result. And here, a lot of effort did not bring a lot of results. That's an interesting data point because it can tell us that, for example, there's divergence of this low compared to this lower low. And if you take the same ones in the CVD, you'll see this. And that typically happens during absorptions. Because this effort did not bring to a result in price, while this effort did. This leg created a leg that went lower. This leg went lower, but not in price. Big effort, less result. So we typically call this pattern absorption. So if this is a lack of participation in the movement, this is a lot of effort in this movement, but very low results, so absorption. So this is what we call an absorption in the CVD. These are the two main patterns. You know, this is the classical bread and butter of CVD, okay? But you want to look at this in the very short time frame typically. You don't want to look at it on a session perspective, because it can be misleading at times. You'll see for entire sessions, the delta going up and price going down. That's completely normal. Look at this one. That just means that in this price swing, buyers were more aggressive, were more on the aggressive side, and sellers were more present in the book on the passive side. So they were more absorbed throughout this whole thing down. This could be a whole absorption, right? But we don't need this. It's not useful to assess long-term price movements. It's really useful for short-term divergences. So a lot of scalpers will use this type of divergence. I personally prefer to use this in combination with the footprint, because in the footprint I can not only spot absorptions very easily, but I can see where they are and what happened right after. So this is a cool summary, yes, but I wouldn't say it's 1000% necessary, okay? But it's a very valuable indicator that you can use, absolutely. So this was the CVD, and in the live sessions you will also see, let's say, more practical examples. But this is all you need to know about one of the main order flow tools. Hi, and welcome back to Auction Market Theory 101 in this order flow mastery course. And we will lay down in this video and the next few ones the basics of understanding of the liquidity auction theory model, which is the ultimately realistic model to analyze market structure based on facts, based on data, based on reality, that deletes all the fluff, all the I think, all the my opinion is, and most of the stuff that you normally are fed in social medias. And we start from this model, okay? Which is a very simple model. Consolidation, balance, fair value, imbalance, no fair value, search for liquidity, price discovery, and then again, balance. Okay? These are the main phases of the auction market theory model. Why does this happen? Well, let's imagine that, as we know, let's say we start from here. We have all of these passive sellers, all of these passive buyers, and there's sellers aggressing the bid, buyers accepting and lifting the ask. And the double auction keeps moving price up and down, up and down. And throughout all of this phase of the market, all four of our forces, passive buyers, passive sellers, aggressive buyers, aggressive sellers, are in a situation of balance, where you'll typically see from the volume profile a situation of fair value and a lot of money being traded throughout all the range. And this is a situation where both forces are agreeing that this is a fair price to trade. That's what we have to understand from this. Because as we know, markets move because of the variation in the perceived value of the underlying asset. So whenever we think that, both sellers and buyers, aggressive and passive, think that this range of price is fair. It's a fair valuation where it's fair to trade, where it's fair to sell and to buy, both aggressively and passively, in a way that makes price action balanced, that will keep the price around the same range. Because of the trading activity that happens behind, makes us understand that that's a fair price for the market. That whenever we try to auction in the higher prices, there's more of a bias to sell. And whenever we move to the lower ranges of the range, there's more of a bias to buy. So a situation of balance is the ultimate description of a fair valuation. That's why we call this the fair value area. But something happens. Something might happen. A news might come out, as we remember the example with Apple. Well, when Apple releases its earnings and it's way higher than expected and they're making a lot of money, well, the perceived valuation of the Apple stock will rise. So if before buyers and sellers were agreeing that this was a fair price to trade, well, sellers might not agree anymore that this is a fair price to trade. Aggressive buyers instead, and all sorts of buyers, will agree that this is a fair price to buy, this is a fair price to buy, this one is as well, this one is as well, and all of these ones are fair prices to buy. And to aggressively accept paying slightly higher prices as long as they can get their hands on the underlying asset. And this shift in the auction typically happens either because, in the most stupid example, something happened, a news came out, or because the net pressure of long-term market participants, taking into consideration the fundamental value, so this fundamental bias is long. And most institutional traders will typically split their orders, right? They will not put their order in the market all at once, but they will fraction it, okay? And they will fraction it in order to not have this impact on price, so that they can get a better fill, right? Because if they were to buy all of these orders all at once, what will happen? They will buy some here, 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 and their average price would be here, for example. But if they buy just a little bit, wait till more aggressive passive sellers come, and then buy a little bit more, and then buy a little bit more, where now their fill is here instead of being up here. So for an optimal execution of these huge orders that big banks, hedge funds, and all of the smart money market participants have to go through, in order to get a better feel of this mass of orders, they will typically fraction their orders, right? And a lot of the order flow you're going to see comes from this perfectly cadenced rhythm of fractional institutional orders, right? And at some point, one of the two flows might outflow the opposition, okay? So in the most stupid example, this happens because of a change in the fundamental perception, but it also could be a continuation of the current perception. Because maybe they just need to pour more money in the market to fill all of their positions, so the auction just goes higher, right? And if I had to ask you a question, right? These buyers that are buying and paying a spread, do they like paying a spread and constantly get filled at worse and worse prices? Do they like it? Not really. What would be the ideal scenario for them? That a huge seller in the book was here, They would buy into it. He would absorb all of them so they can get a good fill because they think price will go up anyways. So they get a better fill. But sellers are not present. Not as much. The book is thinner on the sell side. So what they're actually doing when they're pushing price up because of this aggression is intrinsically looking for liquidity. Looking for counterpart. Looking for an easier way to trade that, they don't get filled at worse and worse prices. They're looking for sellers that consider these prices fair. And they might not find it for a long time. But at some point they will, because prices will rise. And now also the sellers will start seeing this level of price as a fair price to trade, as a fair price to sell. So we will find ourselves again in a situation of balance, where both forces, aggressive buyers, aggressive sellers, passive buyers, passive sellers, agree that this is a decent price to trade. And that's where you see a lot of volume going on. Again, a lot of trading activity. This is where smart money prefer to trade because there's a lot of liquidity. There's not a lot of price movement. They can get their fill very optimally. And that's where the auction clearly tells us something that price action is explaining as a consequence of volume. That the market from both sides is accepting that this is the new fair valuation, that this is the new fair price. Before, this was the fair price. Now this is the fair price. So the auction is likely to keep bringing price up. Okay? This is when a trend is qualified. So not just this, with highs and lows and highs and lows. We want to see this. Market agreeing that that's a fair price on both sides. Not for a small price swing, for a long time. We need proof that all the institutional order flow is on our side. And this is the basics of the auction market theory model. So you got a balanced market, a fair value area, an imbalanced market, and then again, a balanced market. Let's get deeper. It's not just going to go like this, okay? It's likely going to go like this, right? And the next level into framing this in a way that is more realistic is introducing failed auctions, okay? And by failed auction, we mean one of the two parties of the auction auctioning higher, for example. So an attempt to break, that does not happen. Because either aggressive sellers take control of the market, or because this phase of aggressive buying exhausts and aggressive selling starts to take control again and brings price back in a situation of fair value and the auction in a situation of balance. This is what we call a failed auction. Could happen on the other side, right? All of these buyers are considering these prices to be fair enough to push price higher. And if sellers do the same thing and they try and auction lower, well, you could expect the same buyers that bought here, well, now they're going to consider these prices even cheaper. So you're going to have some form of pressure that will lead prices back up in a situation of balance. So this attempt of one party to search for lower liquidity that fails, to try a new price discovery phase that fails, we call failed auction. And it can come in a bunch of different fashions. it could either be an exhaustion from sellers and buyers taking the upper hand again, or it could be sellers being absorbed, that they try to actually push, but they find a wall of passive buyers, and then they simply give up and buyers take the upper hand. So it can either be a dry up in sell volume while going down, or an absorption from buyers. Same thing over here, either a dry up in buy volume, or buy volume increasing but finding a wall. That, like Gandalf, right? You shall not pass. And then sellers taking the upper hand. Same thing over here, right? We had 2 times a failed auction. The sellers tried to auction lower and accept paying lower prices. But the same buyers that considered this, and this is even more powerful, the same buyers that consider these prices to be completely fair, actually super cheap, driving the auction higher, causing a situation of imbalance, well, those ones now are going to be very hungry to buy more. And any attempt to exit the fair value has a higher likelihood of failing than creating a new auction, because you have this to deal with first. You have these prices to deal with first. And buyers were considering these super cheap in a very recent time. But at the same time, sellers might be ready to keep the buyers in check above here. Every time buyers try to attempt auctioning higher, these are prices that for sellers are considerably cheap, or in this case, a really good premium to sell. And they will push price back into balance. This is what will happen most of the time. Price will attempt a breakout. There's only one breakout that works. Only one actually breaks out, because it breaks out. These ones are attempt to break out, but that simply breaks back in. And we call these failed auctions. So you will tend to see areas of balance, areas of imbalance that will coincide with areas of fair valuation from the perspective of volume, low volume areas, and then high volume areas again. Just like this. Areas where market agreed on a price, stay there a bunch of time, and traded a lot of money. Areas where not a lot of volume was traded, not a lot of money was traded, not a lot of time was spent there, but the auction was way more aggressive. So still very significant. These, by the way, are the absolute best trading setups, because you both get the strength of the imbalance, the exit from fair value, and a situation where buyers are also keeping the sellers in check in a situation of fair value. And sellers likely considering these prices a little more fair than these ones. So in a situation like this, where we'd like to take a look at price action, we'll not just draw highs and lows as visual reference points, because this is Dow theory, right? Market is high, market is low, market is going high, market is going low, so higher high, higher low, we're in uptrend, good boy. Yeah. We'll take a look at the market in this way. Where's the most volume traded? Where did the price try to auction? And what happened after? What was the effort? What was the result? This is a much more rational way of looking at markets, because it's based on facts, it's based on data, it's based on volume.